What goes up must come down. The AI trade is at a crossroad. What is the meaning of the breakdown of its correlation with Capex spending lately? How will Google respond to OpenAI's decision to show ads in ChatGPT? Will there be anywhere to hide when the music stops? The AI trade may not be crashing, but it is definitely stalling. Nasdaq 100 has gone nowhere since last October. Its 100-day rolling return is rapidly converging towards zero. Never since the COVID era has the index spent so long trapped in a narrow range. The 100-day moving range has collapsed to just 8%, the lowest level since 2017. More troubling is the fact that market leadership is quietly eroding beneath the surface. Just half of Nasdaq's 100 constituents now trade above their 100-day and 200-day moving averages, a classic sign of internal weakening. Meanwhile, the Magnificent Seven have not been so magnificent lately. After breaking trendline support in the 50-day moving average in early January, the Mag 7 has since broken below the 100-day moving average. We've seen this movie before. Since 2020, there have been 3 other similar episodes of tight range trading following a strong rally. 3, of course, is not a big sample, but in 2 of these 3 cases, Nasdaq 100 went into a correction when the consolidation phase ended. In the other case, Nasdaq saw a 7% decline. If the AI trade has lost momentum, investors have to look further and further into the future to build an investment thesis. We're halfway through the Q4 earnings season. So far, 6 of the Magnificent Seven have released their earnings. The 4-quarter moving average of their combined earnings before interest and taxes, the so-called EBIT, slowed to the lowest level since 2023, despite the rebound at Apple. With the momentum in both stock prices and earning growth fading, the only question is how long before profit-taking begins. The retail buy-on-dip investors have saved the AI trade at least 5 times over the past year. The sell-off of Microsoft in the wake of its earnings in January brought about another surge in retail buying, according to Charles Schwab. How long will retail investors keep playing the white knight? That is the million-dollar question. The release of ChatGPT in November 2022 set off the AI trade. For the subsequent 3 years, the AI trade has been driven primarily by the Capex spending of the hyperscalers. Investors saw Capex as a proxy for expected return in AI investment. The strong correlation between the AI trade and AI-related Capex spending that we saw between 2023 and 2025 was consistent with 2 broadly shared views in the market. 1, that the hyperscalers know better than anybody else about the monetizability of AI. 2, that the more money the hyperscalers pour into AI-related Capex, the higher must be the return on investment that they expect. As you know, I've been skeptical for quite some time now about the validity of the second of these 2 assumptions. My skepticism was the reason why I went short Nasdaq back in September and am still short now. Then came the Q4 earnings season. Over the past month, the correlation between the AI trade and AI-related Capex spending not only broke down, but went negative. For the first time in 3 years, the stocks of the hyperscalers went down and not up on the guidance of increased Capex spending. I will be the first to admit that I'm biased, but I think this could be a watershed moment in the AI trade. What the price action over the past month says to me is that the market no longer trusts higher Capex spending to reflect higher returns on investments. More likely, higher Capex spending is necessitated by increasing costs of everything that goes into building data centers, whether they be high bandwidth memory chips, transformers, cooling systems, construction materials, and grid upgrades. This is even before we take into account of the prices of land in power-rich regions and the wages of specialized workers. It's taken a long time, But the market seems to finally grasp the competitive nature of the AI capex race, that the hyperscalers are motivated less by greed than by fear. The reality is that they don't know any better than you or I if there's a pot of gold under the rainbow. What they do know is that if it turns out that there is a pot of gold, they cannot afford not to be the first to get there. This is almost a guarantee of overinvestment. Unless the pot of gold becomes obvious soon, the only question is when the bust will come. The US Census Bureau tracks AI usage across roughly 1.2 million firms. Before it changed the wording of its AI usage question in November, the survey showed no increase in AI adoption among large US companies between the second and the third quarters of last year. The data based on the old and the new questions are not directly comparable. That said, responses under the new question also point to stagnation, with reported AI usage essentially flat over the past 2 months. Consistent with the census survey is the fact that Microsoft said in its latest earnings call that it now has 15 million paid Microsoft 365 Copilot seats. This is out of 450 million paid commercial Microsoft 365 seats. That means only 3% of Microsoft 365 users have decided to pay for Copilot. This is consistent with reports of high shares of unused Copilot seats in enterprise trials. This does not mean, of course, that only 3% of Microsoft 365 users are using AI. We can reasonably assume that they're likely using ChatGPT or Gemini or other AI models. So how is ChatGPT with still 65% of AI market share doing? This week, ChatGPT started showing ads. It was only 2 years ago that Sam Altman said that such a move would be only a last resort. The fact that OpenAI has decided to go down this path likely suggests that the revenue is not growing as fast as it would like. ChatGPT now has 800 million weekly users, but only 5% are paid subscribers. Whether OpenAI's decision to start showing ads on the free version of ChatGPT will turn around the company's fortune or not, it is a strong indication that it is struggling to grow its paid subscription base. What it says to me is that free AI models are getting too good, or that they are good enough for most people. The best free AI is the AI mode in Google search that is now powered by Gemini. OpenAI's decision to show ads on ChatGPT can be seen as hitting back at Google. I don't doubt that Google will be seeing more competition for its ad revenue that still accounts for 70% of its total revenue. My guess is that this will force Google to beef up the AI mode in Google search further. In other words, free AI will get even better. I strongly suspect the coming battle over the digital ad market will slow the growth rate of paid AI subscriptions. Digital ad spending in the US has been growing faster than GDP only because of the displacement of non-digital ad spending. But digital ad spending now accounts for 75% of all ad spending. The US spends about 1.5% of GDP on ads. Put it into perspective, the 4 hyperscalers alone this year will spend more than 2% of GDP on AI-related capex. For their sake, as well as for the AI bulls, I hope artificial general intelligence is right around the corner. Lately, money has been rotating out of hyperscalers into AI enablers, chip makers, and semiconductor equipment firms. Investors appear to believe that this is the best way to monetize the hyperscalers' capex profligacy. They're right so far. The Philly Semiconductor Index is up nearly 15% year to date. Investors are determined to squeeze every last drop out of the AI trade. The situation brings to mind the famous quote of Chuck Prince, the former chairman of Citigroup. "As long as the music is playing, you've got to get up and dance," he said in 2007, months before the entire structured credit market froze up. The AI music is still playing, and I don't know what will cause the music to stop. What I do know is that this semiconductor cycle will soon be longer than any in history. All I know is that AI-related Capex is growing much faster than AI-related revenue. What this means is that when the music stops, there will be no place to hide. I continue to see the bursting of the AI bubble as the biggest macro risk to the market in 2026. However long it takes for the bubble to burst, the fact that the AI trade has lost momentum makes it easier for me to hold on to my short Nasdaq and long Nifty 50, short Bitcoin, and long 530 steepener positions.